want to welcome everybody. We have Mr. Stefan Nissen. He will be doing our webinar for today. He's financial advisor for Sanlam. So in terms of budgeting and forecasting and planning, everything to do with finances, he is the man to give us this advice. Yeah, and then I'm sure he'll share his contact details and everything afterwards. So yeah, I want to welcome everybody. Thank you for welcoming. I want to hand over, but also a warm welcome from my colleagues from in the training room. So guys, say hi. So I'm sure you can.
Morning, all you beautiful people.
So please, over to you, Mr. Nissen. We are in your capable hands.
Okay, great. So yeah, thank you very much for the opportunity. Very, very honored to be able to share a bit of my knowledge and my expertise on, of course, as the aforementioned, financial planning, and of course we're just gonna touch into the basics of financial planning. We're not really gonna go into too much detail. I don't want to make things too complicated. Things only become complicated on a personal basis, because these things, of course, everything's very, very personalized. So each and everyone has their own financial needs and so on. So we're not going to really dive into the personal aspects of it, more into the broader space, so that the common understanding is at least there. So I don't want to confuse people too much. I just want to keep it as simple as possible. Basically, listen, to just make sure that I don't really use Zoom a lot, so you just need to please bear with me. I normally use MS Teams. Just need to, okay.
Yeah, I think you can just share your screen.
Yeah, so need the presentation going. Right, so just need to let me know if you guys can see my screen.
You can see.
Okay, fantastic. And then, okay, all right, perfect. Okay, so just a brief background about myself. So, born and bred from Rustenburg, so I am Namibian. I did spend a lot of time in South Africa, in Cape Town and in Stellenbosch. So mostly primary school, high school, and I did a few courses, short courses in Cape Town. Came back to Namibia in 2012, and ever since I've been back here. I mean, it's the land of the brave, the land of opportunities. So we always end up back in our homeland again. And ever since, got married, recently had a child, and so yes, so all has been really well, and we can't really complain at all. So I did 5 years at Old Mutual prior to Sanlam, going into finishing my first year off at Sanlam now. So I have fairly good experience of the two different product providers. Excuse me. Let me just put that on silent. Put myself on silent. Sorry. And yeah, so like I said, webinar based as regarding personal financial management. I am accredited financial planner at Sanlam, and of course through our regulator NAMFISA. I just have to mention that they were just aware that whatever I do say, that I am obliged to say what I've said. All right, so I like to always start. People might say, "Oh, you're very, very cheesy or corny," but I like to always start off with a quote from the money man himself, Mr. Warren Buffett. Obviously, he's been there, he's done that, he's experienced it. So he says, "Do not say what is left after spending, but spend what is left after saving." And if we can, of course, apply this type of principle into our daily lives, we can really go very far. You know, we can have progress, but slow progress at the end of the day, and you know, will only benefit us massively if we can follow this type of principle. Okay, just an introduction onto the topics that we of course will be discussing. John, just quickly before I continue, are we going to go flat out throughout the whole webinar, or are we going to have a break in between, or what is the whole logistics around that? John? Okay, all right. If John does hear the message later on, maybe his colleagues, they can just pass it on to him. I just need to know, at least know then how I need to pace myself and how we do it for time and so on. Okay, so just introduction, as I mentioned, what the topics that we'll be touching on. So of course, for the basics, budgets and income, savings, protection, investment, and retirement. The reason why we don't put retirement and investment or savings into the same bracket, because that's a plan, of course, that it's on its own, it's its own entity, and it's of course got its own set of rules as well, which I will explain as we go along. You'll see that investment and savings, of course, is also being separated because there is a difference between the two, and of course we will also touch base on the differences between those two. I mean, if people have questions and so on, I don't know how that's going to work. So again, also colleagues of John, can you also just please communicate that to him? All right. So in personal finance, you of course have wealth management, you have your home and mortgage, you have credit cards, you have insurance, investments, estate planning, you have your risk management, you have your taxes, again mentioned retirement, budgeting, social security, loans and debt. So this of course is the okay, awesome. Thanks, Eunice. All right. Okay, so like I said in the beginning, we won't be diving into each one into detail because they are personalized. So therefore, we of course are just looking at it in a broader spectrum. Okay, so budget and income, down to the basics, and you'll be shocked. I mean, a lot of people on the webinar, if you had to be honest, do you have a budget? I mean, statistics show that 95% of Namibians do not have a budget. Also, from personal experience when meeting with clients, maybe more than 95% of them they do not have a budget. And to me, it's very alarming because I mean, if there's no budget, it means that there's no plan actually, right? So how can you be, as mentioned, how can you be accountable for your spending if you have no plan? And you'll see here the little quotation here with the face of Einstein. Failing to plan really does mean planning to fail. And I mean, it's very true. I mean, you can be the smartest guy in the room, but I mean, if you have no plan, if you have no guidance, if you have nowhere or no idea of where you're heading to, you're most likely heading towards failure. Yes, now and then you'll get a bit lucky, but luck always runs out. So it's not something that you can really bargain on. Okay. So we of course look at a simple idea of what a budget looks like. So this is the tool that we use at Sanlam. And it just gives you an idea of exactly what a budget should look like. I mean, you should allocate every bit of expense to the T so that you, of course, know exactly where your money is going to. And at the end of the day, that you can, of course, be held accountable. So we have 4 sections. So you, of course, have your home expenditure, you have your transport expenditure, you have your health expenditure, and you have your leisure expenditure. This is just based on, this is not a direct client, it's just based on a template. So a young professional, someone that is aged between 27 years and 30 years, that earning an income of 20,000 Rand take home. And this is more or less what the budget, what their budget, of course, but we believe that they would look like. And yes, of course, some people might escalate the car installment. We all know that when we start to earn a salary, buying a new car is always, of course, always the one thing that we do. I'm not one that's against it. I always believe that we should reward ourselves, but reward ourselves within a plan. You know, if you do decide to purchase a vehicle, make sure that it's something that fits to your budget and not just something that you can afford, because we all know that something that you can afford doesn't necessarily always mean it's something that does fit to your budget. So banks are always willing not to give out credit, but it doesn't necessarily mean that you can actually afford the credit. It's something very, very important to consider always when taking out HPs and leases and that type of thing and so on. So we just scroll down to the two important points at the bottom. So of course, unforeseen means that it's something that is not planned. So yes, I've been speaking about stuff that we've been hammering down on planning and so on. But you know, our lives aren't. It's not a fixed book. You know, things are always changing. We never know what's going to happen in the next month. You know, a lot of us have jobs where we are self-employed or where we are contracted and so on. So therefore, it's not always fixed. So it's always best to have then an unforeseen type of plan, just to put away a certain amount of money every month, just know that you have some sort of escape plan if things do go if things do get out of control and so on. Recommended savings, of course, is what we would describe as it can form part of your surplus, your income surplus, or it can become part of the disposable income that you now have available for the type of things that you do need to maintain your personal finance plan and so on. And of course, we will dive into those points. I'm just going to stop here quickly. I'm just going to find out if there is any questions at the moment. Anything around budget and income that anyone wants to maybe ask about. So I'm not sure if people can just unmute themselves or not, or in the chat. Okay, so I think there's no questions, and we'll of course then just continue. Okay, so like I said, and again, please just excuse my cheesiness, but I do live by quotes, and yeah, they always carry a lot of reason. So as I mentioned in the beginning, you know, you can be the smartest guy in the room, and as Warren Buffett himself says, you know, an idiot with a plan can beat a genius without a plan. Okay, sorry, just have something here. Yeah, Tufi, of course, yes. So it's difficult to, like I said, it's just a general. The budget was just just get back to it. It was just a general template, just to give an idea of how to set up a budget. Don't be too concerned about the amounts. It's just more for indication purposes, just to show you exactly how to correctly allocate. So if you correctly allocate certain expenditures, then you at least can be held accountable. So what happens is that people always, you get paid, and then 7 days later you wonder, wow, okay, I got paid, but now I'm left with only 100 or 200 bucks in my account. What happened to my salary? And the only reason why people ask these questions is because there's no plan, there's no budget. They have no idea what they actually spend their money on. So the weekend comes and you go out with friends and you do shopping and you buy things that are unplanned for. And that, of course, then leads to unaccountability. So you have no idea what you're actually spending your money on. So the template here is just to give you an indication of how to allocate your expenditures. So the amounts and so on is not the thing that you need to concern yourself about. It's just more about to allocate it correctly to that expenditure. Okay, so inflation and so on, we will get to that. And so this is just, as I said again, this is just a template of a budget. just to help and guide you to, if you have no, if someone does not know how to do it, just to give you an idea of, I mean, you can take a screenshot, you can take a photo, or you'll see at the end of this, at the slideshow, you'll see that my email address is there. And then I can, of course, send you the template and you have it. And then, of course, you can then use it going forward. Okay, great. Okay, Tufi, I hope that answers your question. So, guys, we're not going to be too concerned about the income bracket. This is just mainly for indication purposes, just to give you the understanding that is needed. I'm well aware that in Namibia that we do have a massive problem with unemployment and people living below the minimum wage and so on. But we're not going to be too concerned about that. All right, it's more just for indication purposes, guidance. Yeah. All right. Good, Tufi, I hope that answers your question. And thank you for your question as well. If any of you else have questions, please feel welcome to just, as Tufi has done, to just drop it in the chat box, and I'll get to it. Just keep in mind that if I am busy with the module, I'll first finish the module and then I'll get around to the questions. I hope that's okay with everyone. All right. So we said on the creation of the budget, we understand exactly how to create one, and of course the purpose around it. So the purpose around the budget, of course, is just to hold you accountable. All right, to hold you accountable for your expenditure, to know exactly where your money, your hard-earned money, is going towards. All right. So we'll move on. So yeah, a man idiot with a plan can beat a genius without it. So as I said, you can be the smartest guy in the room, you can be the smartest guy in the world. If you don't have a plan, someone that has a plan will definitely get further than you in life. It's unfortunately just how the cookie crumbles. All right. Okay, so savings. This is always it's always a topic that we always tend to get confused by. And I did say in the beginning that we will differentiate between a savings and investment. And I hope after this webinar that we at least understand then exactly what the difference is between the two, know when to use the two, when will the one serve the correct purpose for that certain time, for whatever I need to do, and so on. All right. So what is a savings? So the savings has no fixed goal, first of all. So you basically, you save, or you can call it an investment as well. So you save what is available. The reason why I don't want to call it an investment is just because I want us to distinguish the difference between the two, between a savings and an investment. So you basically just save what is available. So when you do your budget and you see that your disposable income, there's an extra $500 or $400 and so on, you then of course then just save it. There's no fixed goal in mind for that savings. There was no analysis tool created, or there was no goal created for that savings plan. Generally, we consider then a unit trust to, of course, be, or any other type of cash savings, 32-day account with FNB, for example, as applicable platforms for this type of purpose. Reason being is that when you have no fixed goal in mind, right, you need those funds to be easily accessible. They need to be accessible at any time, because like I said in the beginning, for the unforeseen, we never know what happens down the line, whether we suddenly need to repair our vehicles if it's not under a maintenance plan, or if we need to do, if there's a leakage at home, then suddenly we need funds to do that, or someone in the family needs to borrow money for an emergency. So there's various reasons that, of course, that can be used as a purpose for the unit trust platform. Essentially, it will then form part as an emergency savings. So therefore, again, there's no fixed goal. We consider this to, of course, be low risk, because at the end of the day, when you need to access those funds, whether it's a month later, whether it's a year later, that the fund value should have not depreciated. The fund value should have not reduced. Whatever you have put in, at least, should still be there. So therefore, we don't give the money a lot of exposure. So when we speak about exposure, we speak about the amount of risk that we're willing to expose your funds to. And yeah, then of course there's no fixed term. So you don't say for 1 or 2 or 3 or 4 years, because again, fixed term works with a goal. And so there, of course, there's no fixed term. So there's no contractual agreement to say that you have to at least keep this investment in place for a 1-year period or a 2-year period and so on. Because again, it comes back to the point of whenever you do need the funds, whenever the funds need to be available, they need to be available then at that point. There shouldn't be any red tape in your way in of course in accessing these funds. It's detrimental that we have these plans in place, because again, as I mentioned, we never know what happens going forward. So when you have this in place and you have this plan in place, and you at least know there's a plan should the emergency occur, that we at least have funds available. Right, so we have a question. Dante, thank you very much. I appreciate it. Let's rather first get to the end before you say the presentation is good. Yeah, we still have a bit to get through, but yes, I appreciate it. Thank you very much. All right, so do we have any questions on the savings platform? So you can see things have been very simplified it as much as possible. So please just also mention that if it's not simple enough, that I please simplify it even more. So that at the end of the day, I want the understanding to be the goal here. I don't want anyone to be confused. Okay, great, Tufi. Fantastic. So unit trust, of course, then would be a very good platform to create your emergency fund. Another thing to mention as well, I said in the beginning, I'm not going to touch too much on products, but just to mention that it is a very low fee fund, meaning that your admin fees for administrating the investment is very low. So therefore, whatever you do put in, you will get back. Just be very careful that on unit trust platforms there is exposure to risky funds, but we don't advise those funds to be used for this purpose. All right, you can put your money into a unit trust if there is a goal in mind, and of course I'll get to that now when we move on to the next subject. Do we have any other? Okay. Recently, the banks have been returning on small investments because startup balance is currently up at 70K. I'm not just trying to understand your recently. Tufi, can you just elaborate a bit more on that? Is it only a specific bank that is doing that? Unit trust.
Okay. Good morning to everybody. I'm so sorry. I just have a question, especially with unit trust.
No problem.
I had a unit trust account with FNB, and then they started closing those smaller investments. If you had anything lower than 70,000 on your unit trust, they were returning back your money because they said the startup is now at 70,000. And honestly speaking, for some of us, the income bracket is very little, and we can just save a very small fraction of money per month. So I just wanted to find out if there are other options for us people who are earning far less and can't afford a 70,000 deposit for a unit trust savings.
Okay, thank you very much. The Tufi.
Please, the name is Tufi.
All right, Tufi, fantastic. Okay, so yes, I think probably there's a bit of gray area. I'm not well aware. I personally bank with FNB, and I'm not aware of any stipulation that says that the minimum is 70K. Across the board, if we take Sanlam, if we take your Old Mutuals, all your financial institutions, your minimum monthly investment for unit trust is $300 per month, and a lump sum amount of 1,000 rand. Of course, it does differentiate between the different funds, but on average, that is of course your more ballpark figure. Again, it is there to accommodate for the lower income spectrum professional, and so on. I will make a note of the 70K thing of your question here, and I will then, of course, then just communicate it to John, or you can send me a message and I can communicate it directly to you once I have feedback on it. But I'm not, as I've mentioned, I'm not aware of any of that. I do know that when which I will speak about now, is when you get to the wealth products, which we then consider as an investment, your minimum requirements are a bit higher because the administration of the fund is a lot more expensive. So therefore, the amount of money that goes in needs to be able to be sufficient enough to be able to run that investment. All right. I hope it answers your question, Tufi. Okay, I'll take the no answer as a yes. All right. So, any other questions on the savings side? Okay, perfect. Thank you, Tufi. Yeah, we will get to the investment vehicles in a bit. I don't want to jump the gun. Like I said, I want to just keep things as simple as possible, just to make sure that, like I said, the main goal here is the understanding. I don't want to mention information, but we're not understanding exactly what it's about. So to me, the main goal here is to get the understanding. All right. I hope that's okay with you, Tufi. And thank you so much for your involvement. I appreciate it. I like it when everyone gets involved and asks questions and so on. It just shows that you are listening. Not to say that the others aren't listening. All right. Okay. Then we'll move on from savings. I take it there's no more questions regarding the savings. Okay, so just to recap on savings, there's no fixed goal. You save what you have available. Generally, the best platform is the unit trust for this, because the fees, your fund fees, so your total T or your expense ratio towards administrating that is fairly low. It's a low risk, meaning that whenever you do need access to the funds, your fund value will have not gone into a minus, or you wouldn't have lost money that was in the account. For example, if you're saving $200 a month or $300 a month, and after 3 months is $900, then there should at least still be $900 in that investment. Just bear in mind that we're not chasing high interest rates and so on with the unit trust investment, solely because of the purpose of being easily accessible. So the funds should not depreciate in value. There's no fixed term, so whenever you do need the funds, they're always available. Okay, so that's on just a recap on the savings side. So we have no more questions on that. Just want to make sure before we move on. We can always come back if someone decides that they suddenly do have a question, and also more than welcome to send me a mail with all your questions and so on, and of course then I can attend to it through that method. All right. Okay, so like I said in the beginning, we will differentiate the differences between a savings and an investment plan. Okay, so now we of course then get into the investment side. So you'll see that the investment side is a bit more complicated, and like I said, we'll try to simplify it as much as possible. But in order to differentiate the difference between the two, we have to dive into the complexities a bit, just to, yeah. Okay, so what is an investment? So here we have a fixed goal. So what clients always ask me, but now I want to invest, but I don't really have a goal. And for me, that is always it's always very, very difficult to stipulate exactly what to do, because when we mention an investment, then we need a goal in mind. So an example of what a goal would be is that I would have a client, the client would come in and he'd be like, Stefan, I have no plans of using the bank. I would like to please purchase a property cash. We then, of course, look at the market and we'd say, okay, fine, the type of area, because the type of area or the type of establishment that you want to purchase will, of course, then depict the amount that you need for your goal. So then you'll say, Mr. Client will be like, okay, Stefan, I want to buy a property in Ochimisen, and I will need maybe 1 million. Then I'll be like, okay, and when do you want to buy this property? And they'll be like, no, currently I am 25 years old and I'd like to do it when I am 32. So we have a 7-year period. So what we'll do is then we'll take the 1 million and we'll plug it in, and then we will then work out, of course, what needs to be invested in order to achieve that $1 million. So that would then, of course, be an example of an investment goal. The same can then be applied to a study policy. So you want to invest money so that your kids can one day go to tertiary education. We always, of course, want the best for them. So if they want to go and study at UCT or at Stellenbosch University, we, of course, then derive all these plans for that, and work out the amount of money that needs to be invested on a monthly basis. Money can also be invested in lump sums as well, or in ad hoc. So you can have a recurring investment, and then, of course, when you have additional lump sums, then you can, of course, always then just add it on, thus escalating the goal that you need. Another one, it could be that you want to purchase a car, or you want to start up an investment, and so on. So these, of course, are all just various purposes that could serve as an investment goal. So when we speak about investment, we always want to make sure that we at least have a goal, so that we at least, of course, know where we are heading to and what is the purpose of this investment. I found out that in the experience of being in the personal finance management space and so on, is that when people understand the purpose of having something, they tend to keep it, and they tend to have the discipline of seeing it through, because, of course, they understand why they're doing it, and at the end of the day, that's the most essential reason, that's the most essential principle that we want to achieve. Okay, so like I said, the investment goal, the investment amount is, of course, derived from the goal. So like I said, whether it's to purchase a property, we then work out what is the amount that is then needed in order to achieve this goal. So when we do an investment, because the investment period is generally like to think of it being 3 years, or for me 3 years is still a bit too short, so 5 years and longer, we do then tend to give a bit more exposure to your money, because if the markets should dip, there is enough time then to recoup funds that have been lost in that period. So we do look at wealth products. Wealth products just allow you to, of course, give you more exposure. So there's more variety in terms of the investment funds that are available. So it's not just your local funds, but it's also funds that are outside the borders of Namibia. So investments tend to be medium to high risk, because then again, we do give more exposure. So therefore, the more exposure that we allow for your money, the more risk that is tended. And then again, also, then we have a fixed term. So like I said, we work out, we first get the purpose. So you first get your investment goal, and then we, of course, then look at a feasible time frame to achieve that. I've had clients that come in and be like, I want 10 million, or I want 5 million, but I want it in 5 years' time. And I mean, it's my job to show them what they need to invest and what needs to be done in order to do that. And even if they can't afford it, they appreciate the fact of just having that information and being aware of, okay, but this is the plan, this is the guideline that I need to get to in order to achieve that. And a lot of them come back and they'll be like, then rather start with a lower amount, and then we can, of course, then work up to that. And 100%, yes, we can. Because again, remember, goals are guidelines. So it doesn't necessarily mean that we have to immediately start with the amount that the analysis showed us. We can always start with a lower amount, say with 50% or 25% of that amount, and then, of course, we can work up to reaching the desired amount in order to achieve the end goal. Right, let's see, we have some questions. I'm just going to have a look quickly. Okay, Tufi, you're on the ball, eh? I like it. When it comes to investing for a specific goal, if let's say I would like to buy a car in the next 2 years at 350, what would a typical lump sum amount would one be required to invest? Just a rough amount. Okay, so as I mentioned in the beginning, we're not really going to dive too much into the personal aspects, but of course I will make an exception. When we're speaking about a lump sum over a 2-year period, just remember that it's strictly only a lump sum. There's no contributions, so that is strictly dependable only on the market itself. So a 2-year period and a lump sum amount. So, for example, if the investment is doing 10% on an annual basis, and you put down 100K over 2 years, you only achieve around, so you achieve 10K in interest, meaning that over a 2-year period, you will probably achieve just about 20K. So 120K would then be what you would achieve. So when speaking about an investment goal to get to a lump sum amount, it's always best to put down a lump sum amount and then to, of course, have an ad hoc or contribution in order to achieve that. So again, just remember always that the shorter the term, the more expensive it's going to be. So, for example, a 2-year period and you want to buy a car for 350 and you want to put down a lump sum, then you might as well just put down the 350 lump sum. Okay. All right, perfect. Thank you, Tufi. Is there any other questions on the investment side? Any other question, guys? Okay, I take it there's no questions. So we'll just do a quick recap on investments. So you have a fixed goal. The amount that you invest, of course, is derived from the goal. So whether very, very common scenarios would be when purchasing a property. People don't want to pay the high interest rates to banks. They'd rather invest that money and then buy the house at a later stage. It is something that I do advise as well. Because at the end of the day, property is a liability. So if you can rather plan for it before it becomes a liability, then that's the end goal. But of course, financial times don't really allow us to have that type of capital available. We need to use the financial institutions to do that. But when it does allow it, then I always, of course, say that that's the prime one. We definitely want to take that route. We use wealth products, so we want to give the money as much exposure as possible. So meaning that we want that money to really work for us at the end of the day. That's medium to high risk, and there is a fixed term. So you are most of the time there is a contract in place to say that you invest in this money for 5 years or for 3 years, 10 years, and should you break contract, then you will be charged a penalty. All right. Is there any other questions on investments before we move on? Nothing? Okay. So we have the understanding, happiness. Awesome. All right. So as Tufi mentioned earlier regarding equities and so on, so we'll just touch base quickly on investment vehicles. So basically, investment vehicles are the different modes where your money can be invested in. Generally, we only have 4, but you'll see at the bottom, the new one has come into the picture, and it is something that we have started to strongly consider, just solely for the point of just giving the money as much exposure as possible. So you have your cash, which we consider to be your money markets, which is conservative, so very, very low risk. You have your fixed interest and your government bonds. Fixed interest, of course, would be your income funds and your government bonds, which is considered to be moderately conservative. You have your property market, which is considered to be moderate. You have equity, which is moderately aggressive. And of course, you have the global offshore funding that is considered to be your most aggressive option. Okay. So the reason why cash or your money market is considered to be conservative is because, if you have $50 right now, today, and you put that $50 away and you come back 6 months later, that $50 will only still be worth $50. All right. So the amount of fluctuation or the amount of volatility that is in the cash market is very, very small. So it doesn't really move up and down, right? It stays pretty stable. The same applies to your fixed interest and your bonds. There is a bit of movement, but it's over a longer period. So it's over 6 months or 4-month period when of course the repo rates and interest rates and so on have been adjusted, and that of course all affects your bonds market. Property the same as well. It is a bit more volatile than as we have noticed in the last 3 or 4 years when we did catch a very, very big dip. Good news is it's on the way up. So once something has reached rock bottom, it has the only path that it can now lead is of course is up. So it is slowly starting to recover again. But generally your property market prices do fluctuate on a 3-month to a 4-month basis. So therefore, it is considered to have a lot more risk than government bonds. That is a bit more stable, and of course, cash that is the most stable option. Then we have equity. Equity considering to be moderately aggressive. So of course, it's actually moderately aggressive to aggressive because equity is basically company stocks or shares. And what that means is that, I mean, if we look at, for example, Namdeb shares or Trustco shares or MTC shares, and the share price currently is at 10 Rand. 3 hours later, it can be at 20 Rand, and then another 2 hours later, it can be back at 10 Rand. So the amount of volatility that is in equities is very, very high. So, of course, it's moving up and down like that. But at the end of the day, you, of course, want to meet in the average when you're speaking about equities. And then, of course, I'll get to that point just shortly of how we, of course, do that. Global offshore, of course, is your most aggressive option because then we're speaking about international equity and international markets. So, for example, you can have a bit of the Nasdaq, where you can have a bit of, and within the Nasdaq, you can have Apple shares in your portfolio and so on. So, of course, that is very, very volatile because it's international markets. We're speaking about various time zones and so on. So the markets, of course, are always moving, and therefore, within a few minutes, your money can, of course, be a different value. All right. Whilst we are in the investment vehicle space, I'm just going to touch on, well, before we move on, let's just say we have a question here. Okay, we have it from Achila. Morning, sir. How do we access government bonds? Just hearing these fancy words, where do I get to full info and to invest into it? Thank you. Okay, Achila, that's exactly what I'm going to explain now is with my next point. So within the next module, what I'm going to explain now will answer your question. So when we have our investment vehicles, we have two types of funds. So you have on the one side, you have your index funds, and on the other side, you have your mutual funds. So you'll see here on the picture or diagram that you'll see that there's percentages, that is allocations. So these percentages do not apply to, for example, only to cash or only to fixed interest or only to property. It actually applies to the whole pool of funds. So that's, of course, the difference between an index fund and a mutual fund. The index fund means that you go directly to the stock market and you buy directly that share or that fund. So, for example, if you want a government bond, then you go directly to Bank of Namibia and then you purchase your government bond. And whatever happens to your money is solely dependent only on the government bond. There's no buffering from cash markets, from equity markets, and so on. It's solely only on the government bond. The same applies to equities as well. If index fund, you go to a brokerage like PSG and you buy Ellie's shares or you buy Anglo-American shares, then your money is only strictly dependent on how that share price then performs. So if, for example, if Anglo-American, their production doesn't meet their targets, then of course their share price then dips, and therefore your money then dips. So there's no buffer that is of course stabilizing your money. When you speak about a mutual fund of course means that then you have access a bit of each. So you have a bit of cash, there you have a bit of bonds, you have a bit of equity, you have a bit of property, you have a bit of offshore, and so on. And we've all heard of the saying, of course, you don't put all your eggs in one basket. And the reason why we do this is, of course, is just to safeguard your money. So yes, on one side, we want to, of course, give it as much exposure as possible. But because we know what markets can do, and of course, what it can do to our money, is that we also want to create some sort of safeguard. So you'll see that here you have 20% in cash, you have 25% in fixed interest. You'll do maybe 10% in global, you do 25% in equity, and you'll be 20% in property. Meaning that should, for example, your global or your equities catch a dip, you know, there will be a safeguard buffer then from your cash markets and from your fixed interest bonds market and so on. And vice versa will then happen the same with should the equities perform and the bonds market should catch a dip, then you know that the equities and the global offshore markets, and of course will then safeguard that. Should the cash markets or the fixed interest of course remain stable and the equities and global offshores perform magnificently, then of course at the end of the day you will then of course then just benefit from them. So like I said in the beginning, we want to give the money as much exposure as possible, but we're not in the business of losing money. We're not gamblers, eh? We want to make sure that we give the correct financial advice, and we want to make sure that we do it for the correct purpose and for the correct goal, of course, at the end of the day. See another question. Is there entry amount to buy government bonds, and is it only Bank Windhoek? Okay, it's not Bank Windhoek, it's the Bank of Namibia. And I'm not too clued, I'll be honest with you, I'm not too clued up on the amounts. You do get different types of bonds. You get the 6-month bond, you get the 1-year bond, and the amounts and so on, I'm not too clued up on. But say, for example, you buy a 1-year bond for 100,000, and you buy it at an interest rate of 8%, then of course then it's 8,000 that you of course then will then get back on that investment. So yeah, bonds, Bank of Namibia, that's the correct platform to use for government bonds. It is a good investment to have in terms of having a stable investment. Currently, we do not have any excessive inflation, and so therefore government bonds are a safe investment vehicle to use. So the bonds market is a good place to of course get your money to work for you. Do we have any other questions on investment vehicles? Okay, I take it that we don't. And yeah, so that's just.
Sorry, Stan.
Yes. Hello.
I'm driving, so I'm just wanted to ask Clay. Or I'd rather confirm. I was just talking to my aunt. Yes, FNB did close down all of the unit trust accounts. If you had a unit trust with less than 70,000 invested, they closed your account and returned your money back to you. That's why I'm really concerned, and that's why I asked that question about the unit trust. I'm sorry for taking you back.
No problem, no problem. So yeah, so I wasn't aware of any of that, and to me, I mean, it's quite alarming that they would do something like that. Unit trust is normally considered as your risk free. So again, that's why we are in the financial advisory space, is to make sure that the correct information is shared to the public. So when speaking about a unit trust investment, we want it to be a low risk, so it serves the purpose of a low risk investment. So therefore, it should not be your prime investment. Therefore, we don't really speak about high interest rates and high investment amounts. When you want to do a high investment, a lucrative investment, of course, would be the better wording. Then we want to give that as much exposure as possible. So there's no point in, for example, if you invest in 5K per month into a unit trust, and it only does 6 or 5% per year, but you can rather be putting it into a platform that's doing 10 to 12%. You know, that of course then would mean that the money would then do a lot more work for you at the end of the day. So we want to make sure that we are serving the correct purpose for the correct investment or savings. So I'm quite alarmed to hear that FNB is doing that. And I will just also do my own personal investigation regarding that. But as far as I'm concerned, unit trust with Sanlam, unit trust with Old Mutual, Momentum, the minimums, they are fairly very affordable investment plans. So if you have a 70K that FNB is sending back to you, more than welcome to bring it to Sanlam. All right. So that was Tufi. Tufi, I hope that answers your question. Okay. No, again, I take no answer as a yes. All right. So no questions further on the investment vehicle side. We of course understand all the different type of investment vehicles and their risk profiles, where they best suited for certain investment goals. So just to give an idea, just to again simplify even more, so we just have 100% understanding. Cash money markets are all considered for unit trust and low risk. So therefore, the short-term investments are the same with your fixed interest and bonds. And for property, equity, and global, we then consider 3 years generally, but my personal advice is 5 years and longer. Just for the sole fact of, should there be a market dip, that there's enough time to, of course, to recoup those funds. We can't guarantee anything when it comes to investments. We don't guarantee anything. So whenever someone says you can guarantee this, they're lying. That you can't guarantee anything. Same with cash as well. We can't guarantee that we won't become, for example, like a Zimbabwe. We can only hope that it won't happen, that we won't have any excessive inflation, that our government will always make sure that our financial sectors remain in control, our exchange rate remains in control, and we just continue to develop as a proud nation, as we Namibians are. Yes, so just to wrap up on the investment vehicles, are we all happy with the understanding on that? Okay, I take no answer as the yes. So we can move on. Okay, so at the end of the day, how do we achieve investment goals? How do we achieve the purposes for our investment goals? And like I mentioned before, if one guy can be a genius, but if you have no plan, the chances of you failing is very high. The other guy can have a little bit of understanding, but he has a plan, and the chances of you failing is a lot lower. And it all comes down to consistency. I mean, if you consistently do anything, so let's take, for example, a sportsman, Cristiano Ronaldo or Lionel Messi, those guys train on a constant basis, and they wouldn't be where they are today if they did not train on a constant basis. All right, they wouldn't be performing at the high levels that they perform at if they don't do what they do consistently. And the same thing applies to your investments. If you consistently invest whatever the amount that you derive from the investment goal for that investment period, you will achieve the goal. It's very straightforward. So it's the same thing that Warren Buffett says as well. It's not about quickly entering the markets and getting out. It's about spending as much time as possible in the market in order to get to the investment goal. And it all comes down to the end of the day to consistency. So if anything, I mean, it doesn't have to just be investments. It can be anything that you do in your life. If you do it consistently, you will achieve your goals. And I think that's probably a mandate that we should really inflict into the Namibian public, across the board in terms of servicing. So all our network providers, all our financial institutions, our public sector, if they can do everything consistently, we will have a great nation, and our nation will really run smoothly. That I can guarantee. Okay. Any questions? Okay, there probably won't be much questions on a statement. Okay. All right. So this, of course, is always a very sticky point when I'm speaking to my younger clients, and of course to my older clients as well. because with my older clients, it becomes very, very uncomfortable. And it's just strictly down to preparation. And again, you know, it comes down to the budget thing. Retirement works the same. So how well planned are you for retirement actually? I mean, are you aware of the amount of capital that you need upon retirement? What is the type of lifestyle that you want when you retire? I mean, when you retire, do you need to scale down, or can you maintain your lifestyle? Are you aware of any of that? And of course, then how do you get there? And the big one is, can you build wealth through retirement? And people are always shocked when I tell them that, you know what, the easiest way to build wealth is through retirement. It's the most easiest way to build wealth, people. And people are always shocked. They're just like, no ways, that's impossible because I don't have access to the money and so on. But then again, it comes back to, remember I mentioned about the consistency. So if you consistently do something, you will then, of course, you will achieve that goal. So whether it be for retirement or whether it be for buying a house, do it consistently, you'll build it. So if you want to build wealth through retirement and you do it consistently, you will then achieve that. All right. And I mean, I always tell my clients, and it's one of the things that I want to inflict in them, is that you live this type of lifestyle now, right? You live a good lifestyle, you're comfortable, and at the end of the day, you're okay. Why do you want to put that in jeopardy when you retire? Very, very straightforward question. Why? Or do you want to put that in jeopardy when you retire? Or should we work out a plan to avoid that from happening? And most of the time they'd say, of course, Stefan, I listen to your advice and therefore tell me what I need to do. All right. So one of the things that we want to achieve is that you work so hard on a daily basis, Monday to Friday. Some of us work Monday to Sunday. Some of us work on Saturday. And, you know, even public holidays we are working. So our money is hard earned. And the amount of sacrifices and the amount of time that we put into earning our income shouldn't just be taken lightly, and also shouldn't just be thrown away. So when we get to that point of when we aren't working anymore and we're going to settle down, why not enjoy it? Why not have an even better life? All right. So these are the type of questions that I ask and that we as an immigrant public should be asking. And then, of course, how do we do it? You know, you mentioned all of this, but then how do we get there? All right. And I'm just going to show you a simple tool that we use for retirement analysis. And again, we're just going to go back to the template of the young professional guy that is 30 years old, that is earning 20K per month. I know that Tufi mentioned that, but we're not all earning 20K per month, 100%. But again, it's only for indication purposes. All right. We're not too concerned about the amounts, and we're not too concerned about the income. It's just all about the information and of course the understanding to know that, okay, fine. But if I'm earning 10K, then of course this is what I apply. Or if I'm earning 15K or 5K, then of course this is what I then apply. All right. So this is an example of what a retirement analysis will look like. So we go back to Mr. Client that's earning 20K per month. And so, of course, we then ask that first question of how much capital do I need upon retirement to ensure that I then still earn 20K per month. Remember, so the very important thing to remember is that Tufi mentioned about inflation. And inflation is a very, very important aspect to remember, because everything gets more expensive on an annual basis. Our income doesn't necessarily always increase, but inflation does, and it makes everything more expensive. Therefore, if you have 10,000 Rand or 100,000 Rand today, 10 years later, that 100,000 Rand will not be at the same value. So we need to make sure that we are maintaining our money power, so that our money power is always there. So, for example, if I have 100,000 Rand today, 10 years later, that 100,000 Rand should have the same value. All right, so that's a very, very important aspect to remember. So we go back to those questions of how much capital is required. So for Mr. Client will then need 31 million in his retirement investment, so 31,328,000 to be exact, in order to ensure that he then retires with his current income. How does he achieve that 31 million? Mr. Client needs to invest 5,244 Namibian dollars per month to achieve that 31 million. But we have inflation. So our inflation on average in Namibia is always between 4 and 5%. We want to safeguard our retirement investment. We don't want to run the risk of putting that into jeopardy. So of course, affordability always plays a big picture, but when the optimal goal is to ensure a safeguard retirement investment, we then look at an annual increase of 10%, meaning that it's inflation above inflation. Should we come into the situation where we're moving towards Zimbabwe and excessive inflation is coming into the picture, we at least then know that whatever we did contribute to that point has been safeguarded, and therefore our retirement investment, of course, has been secured. So it's just to give you an idea of what a retirement analysis would look like. So again, we come back to the questions of what do we need? So Mr. Client will then need that amount based on his income. So of course, this amount will always be different compared to each individual. Again, it's called personal finance, so therefore it's personalized to your needs. So everyone's needs is different. There's no group or blanket approach. Everything is personalized to your needs. Right, that's why I have a job. Okay. So of course the monthly contributions will also always be different as well, because that will then depict on the amount of or the income that is required. Yes. So then also just to touch on, we all of course on our toes regarding the new FIMBIL, the new FEMA Act that has been rolled out by Parliament. It hasn't been confirmed. There is a lot of sticky tape that needs to be cleared out. So as things do stand, we are currently on the normal pension rules, the Regional Pension Act, meaning that 1/3 is a tax-free lump sum and 2/3, of course, will then be further invested to provide you with that monthly income. All right, just to clear that up. I know people, they're always asking me, but with the whole FEMA Act, does the pension rules change? We can only work on what is current, and therefore that's what we apply to. All right, so do we have any questions regarding retirement planning? Again, remember I mentioned that I put retirement planning as a separate aspect, because therefore the reason why we do that is because it has its own set of rules, and of course it serves its own purpose as well. All right. Okay, so I take it we have no questions. Okay, fantastic. John, have you returned?
No, he's not around. I'll be taking over.
Okay, is it Eunice?
No. This is Genevieve.
Genevieve.
Yes.
Okay. Are we going to push through in one go, or are we going to take a short break?
Are you not done with the presentation yet?
No. There's still probably another 20 minutes.
Oh, okay.
So I don't want people to be.
Excuse me?
I just don't want people to be too. Don't want to throw too much information at one go. Like I said in the beginning, the main goal here is for understanding. So if what I've mentioned already is a bit too much, might probably help to just take a short 5-minute break, just to stretch the legs and clear the mind, and then of course come back again. Or we can.
Okay. Now we can take some questions if there are any.
Okay, all right. So we can open the field. So are people allowed to just unmute themselves?
Yes.
Okay, great. So if there's any questions, please feel free to just unmute yourself, and then we can address them. If not, there will be a question and answer session at the end. So yeah, if within a minute, if no one has mentioned anything, then of course then we can just push on them. Is that fine, Genevieve?
Excuse me?
Is that right?
Yes, yes, yes.
Okay, perfect. Because I take it there's no questions, so then we're just going to move on.
Yes, we can move on now.
Okay, great.
And then we can take we can hear from the audience maybe later a few questions that they might have. If they don't have
Yes,
any
it's
now.
100%. There by you guys in the room,
Excuse me?
from your colleagues there with you.
Yes.
Okay, 100%. So like I said, yeah, there will be a question and answer session right at the end.
Yes.
Okay, perfect.
Right.
All right. So again, retirement savings is a tax benefit, guys, meaning that you can deduct. Currently in Namibia, again, when the FEMA Act does change, the amount will be increased. But currently it is at $40,000 million per tax period, meaning that you can then get a certain percentage back on whatever you contribute towards a retirement plan. You can get it back. So imagine on one end you're busy building wealth for your retirement, and on the other end you're getting back on an annual basis. You're getting back on your retirement. It's the best investment. It's better than any investment returns that you will get on the market. This is the best investment that you can get. And again, it just comes strictly down to the consistency. If you do it consistently, you will then reap the benefits from that. Very, very straightforward. So do we have any questions regarding the tax? Okay, we'll move on. All right. So now we've spoken about our savings and our investments and our assets, and you know that those all do form part of our assets. But there, of course, there's been one thing that we haven't spoken about, and it's considered to be your most valuable asset to many. Many aren't aware that it is the most valuable asset, and so I'm just going to open the field here. I just want to get an idea of what people think would be the most valuable asset. If people don't be shy, just mention. I want to just get an idea of whether we are thinking and understanding it. So what did you guys think, the audience, is your most valuable asset? Anyone? Anyone want to take a stab in the dark? No one? Oh, we're a bit shy. Okay. All right. We'll move on. So you would think that our most valuable asset, of course, is probably our house, or the car that we drive, or the laptop that we use, or computer that we use, or a cell phone that we use. Might be our wife, our family, you know. And yes, they do all form part of being very, very valuable. But there's one thing that we're forgetting, is that how do we accumulate? How do we get access to these assets that we have? So how do we get access to our house, or to the car that we drive, or the laptop that we need to buy, or the cell phone that we need to conduct business and communicate with certain individuals, or the investments that we put into place, and our retirement planning that we put into place, or our savings, and how do we accumulate all of that? Anyone want to take a guess again before we get to the answer? No one is willing to take a guess. Okay, so of course that's our income. So yes, your income is the one that makes all the other assets possible. And through your income, you are able to safeguard your future through all these factors that we have mentioned now previously, leading up to your most valuable asset. Guys, without your income, there's nothing that we can do, right? We can't purchase any assets, we can't put any investments into place or savings into place. Without an income, we won't even have a budget. So even from the beginning, without an income, we can't even start with the most basic thing of having a budget. So therefore, this is the first thing that we, of course, need to protect. And the reason why I've left it at the end is because it's the last thing that, of course, that I want you to remember, is that this is the one thing that we need to safeguard. It's the one thing that, of course, ensures that all the other assets are possible. So the house that we live in, or the apartment that we rent in, or the car that we lease in and drive in, or if we need to send kids to university, and of course any investments that we need to create and so on. All of that cannot be possible without the income that we earn. So therefore we need to safeguard it against basically everything that allows us to safeguard it against. All right, so of course then how do we of course protect our income? So there is various platforms available in order to do that. And I think it's very, very important to remember that we need to distinguish the difference between the income protection and a disability cover. And the reason why I've added this into today's presentation is because, remember, I said at the end of the day, we want it to be understanding. And if we can understand the difference between the income protection and disability cover, then we of course will then know when each one needs to serve its purpose. So income protection in itself, the name is there, it's there to protect your income. So how do we earn that income? We earn that income through the work that we do, right? So therefore, we safeguard that aspect. So we safeguard our current occupation. So it doesn't matter if now you suffer an event, a car accident or an illness, and you recover from that, but you're an accountant. You can't use the one side of your brain. You can't be an accountant anymore. You can now therefore work in a clothing store. All right. So remember now, going from an accountant to working to a clothing store will impact you financially. So therefore, we don't want that. So that's why we protect our income to be that accountant. So therefore, if you aren't able to be that accountant, your income protection plan will then kick into place. All right. So that's very important to remember. Disability is a blanket statement, meaning that if you're not permanently and irreversibly disabled, right? So if you're not a vegetable, that will not. So if you're able to work in the clothing store, which means that you're not permanently and irreversibly disabled, it means that then therefore your disability cover won't pay out. Right. So it's very important to always to remember and distinguish the difference. And the aim here is to protect our income. It's not for disability cover. Disability cover is more for in terms of if you need to make adjustments to your car or your wheelchair, make your home wheelchair friendly, or you need 24/7 nursing care, and so on. That is more for disability cover. Income protection is there to protect your income. It's there to make sure that you are able to buy the assets that you currently own, and to, of course, then to maintain those assets, whether it's your house, your car, your investments, your retirement plan, and so on. So everything that you have in your portfolio is all only through, unless you inherit it and so on, of course. But mainly it's strictly through your income protection. All right. So of course, within your income protection, you have an impairment and you have a sickness cover, which allows you to have a short-term income protection plan and a long-term income protection plan. Short-term, of course, being for anything that you suffer and you haven't recovered from it within a 2-year period, and of course, long-term being anything that you haven't recovered from after a 2-year period. So at the end of the day, is that we want to put you in the same financial position that you are in after something has happened. So obviously on the emotional side, there's not much we can do. We aren't therapists. We don't, well, we do offer, I don't offer counseling, but there are, of course, there's aspects of certain platforms that have it. But the main point here is, of course, to ensure financial security. And that's what we are here to do, is to inform you of ways to ensure your financial security. All right, do we have any questions regarding income protection? Okay, just to mention that we always get that question of, yeah, but what happens if I don't use it? What happens if I don't need it, and so on. So then, of course, there are two aspects. So one thing is that we're not perfect, right? If stuff do happen, we do fall ill, and it's just part of human nature. As we become older, we do fall ill, and statistics show that working class from age 48, actually, 48 and above, they do start to suffer some sort of illness, whether it's high blood pressure, whether it's diabetes, and it does start to affect the ability to do their job, whether how high strenuous their jobs are, whether they're a doctor, whether they're a specialist, whether they're lawyers, whether they're chartered accountants or engineers. It does start to affect the ability to do that job. Your employer will start to recognize that, and they will start to look at ways of releasing you. And it's just a harsh reality of the world that we do live in. You know, the first guy in is always the first guy out, you know. And that's unfortunately just how it works. When young, fresh blood comes in, someone that has the more or less the same experience as you, and maybe even more qualified, and you are starting to show symptoms of not being able to fully fulfill your job, you will, of course, then become in the shooting line. And so at the end of the day, we just want to, of course, ensure that you have financial security in terms of your current financial lifestyle. We don't want you to have to downgrade or make cuts and so on. Our prime goal here is to, of course, ensure that we can ensure that financial security, and of course then to maintain your desired financial lifestyle that you want at the end of the day. Okay, so do we have any other questions? So again, guys, I'm not going to go into details regarding products and so on. That will all be done on a personal basis on those that are interested and want to find out more. Again, it's all just about information, just being aware of, okay, this is what is there, you know, the opportunity is there. I can't currently afford it, but later on I can always come back and be like, okay, fine, I'm in a better financial position now. It's something that, of course, that I want to then consider. So then, you know, just being aware and having that information means that you can plan towards it. And so that, of course, then just makes a massive difference. Okay, guys, so of course we're going to wrap it up. And of course, we have to wrap it up with the money man, Warren Buffett himself. And so the most important investment that you can make is in yourself. And it's 100% true. And not only is it the most important investment, it's the one that you can afford. You know, you can afford to invest in yourself. You can afford it. You have the choice of making that investment and to do it in yourself. You know, we only have one life, and we only have one life to live. And the life that we live is all dependent on the choices that we make. If we make the correct choices and we put most of the correct choices into ourselves, we can only improve. We can only, you know, we can reduce the amount of strain that we put on ourselves. And not only that, depending on, of course, the industry that you work in, it can positively affect that industry, or it can positively affect your community. And once a community gets involved, it starts to affect that town. And you know we really get into, once a town is involved, it affects the city, and once a city is involved, it affects the nation. And at the end of the day, this is what we want to achieve, right? We want to make Namibia great. We want Namibia to be the best country to live in. And in my opinion, we definitely moving towards that. Eh? Namibia is a fantastic country. We have amazing resources. Yes, at times the opportunities to accessing those resources can be a lot better allocated towards in terms of localizing it. But you know, it is there, and the access is there to it. And I think we should sort of piggyback ride on all the successes that, of course, that our country achieves. And yeah, I'm humbled, and I'm really a proud Namibian citizen. I love my country. I love my people. Yeah, everyone's just amazing. Yeah, humbled, blessed. Just can't complain at all. And I hope that all of us can share the same insight that I have. And I hope that I can carry it over to you, you know, to feel it, you know, that the proud nation that we are. We don't allow anyone to just step over us. No, that's not who we are. We are proud Namibians, and we are able to stand on our own feet, independent, wonderful, fantastic, awesome. Thank you so much for your time, audience. It was really a massive honor. Thank you, John. Thank you to the Diamond Training Institute. You guys have done an amazing job on educating and on informing our nation on all the different aspects of our daily lives, on how to do better and how to improve ourselves, not just mentally but also spiritually as well. It's really fantastic. It's really humbling. And when I got the opportunity from John, you know, even though it doesn't matter how much work I have or how full my schedule is and so on, this is really something that I wanted to do, and I was really happy that I got the opportunity to do that. I hope it was informative. I hope that we achieved our goal. At the end of the day, is that we understand exactly what the presentation was about, and how to go about it, and so on. How, of course, we can apply it in our current lifestyles. And yeah, guys, really, thank you very much for your time. I appreciate it. Genevieve, is there anything on you guys' side? Of course, there's questions. So the audience is now free to shoot with all the questions that they have. Yeah, and of course, looking forward to my email. Sorry, my email address is at the bottom for you guys. As usual, you're more than welcome to make use of it. Whether it's only for information purposes, consultations are free. Whether it's face to face or whether it's online, you know, I am here to fulfill that need that you might have. Yes, I can hear background noise.
Okay. Now, if you can pop your questions from the chat box as well if you're too shy to speak. Not a problem.
Okay. So if you guys have questions, you heard Genevieve, you can pop it into the chat box as the rest have been doing, as Tufi and Ujila has been doing. Or you can unmute your mic, and of course you can then go ahead with your question. I take it there no questions. Anything on you guys' side, Genevieve?
Now, no questions on our side.
Okay, from your colleagues, they're sitting by you, they have no questions.
You need to have any questions?
Sorry?
No questions, no questions.
No questions?
Yes.
Okay. Right, so then I think then we can probably wrap it up. Again, thank you very much for inviting me to be the presenter on your weekly Wednesday webinar. And yeah, hopefully we can do it again soon.
Okay. All right, thank you. Can the people email you if they have any questions as well?
Yes, 100%. So like I said, email address is there for your perusal. You can shoot ahead with anything that you might want to inquire about, whether it wasn't mentioned in the webinar, whether it's something that's off topic. The spectrum that I cover is very, very broad. So I do personal finance, but I also do corporate finance as well. But the purpose of today's webinar was to focus on the personal finance, financial management aspects, and so on. So that's that's what we did today.
All right.
Thank you, Sheila. Blessed day to you.
The presentation will also be available on our Facebook page for those that have missed it. So
Okay,
you can
fantastic.
have a look at it on our Facebook page. Thank you.
All right, thank you very much.
Stefan.
Thank you very much. Blessed day to you all. And thank you.
All right, thank you.